Here in the Cape Town studio with me is Stephen Nathan, who's the CEO of 10X Investments. We're going to talk about own goals. If you watch my football team, you'll know that own goals are a fact of life. But what about in the investment world? 3 own goals, and you talk about earning lower returns before fees, rather, Stephen. Number 2, paying higher fees to further reduce their return. Number 3, paying performance fees despite underperforming. Now, I'm not clever, but fees seem to be the theme here. Let's go to number 1, earning lower returns before fees.
Yes, if you look, Lindsay, at pension funds, when they publish their performance returns in the surveys, they always show the return before fees because different clients pay different fees. So if you look at, we've taken the Alexander Forbes Large Manager Watch survey, which includes about 20 of the largest, most popular retirement funds, their long-term portfolios.
That came out last week.
So yes, it comes out, say, kind of every month, but we looked at the annual one for 2014. And if you look over 1, 3, and 5 years, the average large fund manager consistently outperformed 10X's index fund. So had you owned a well-constructed index fund, you would have beaten the majority of fund managers before fees.
Yes.
So that's the first own goal, is that you earned a return below the index before you even pay fees. As you mentioned, the second goal is that, well, I'm actually paying for poor performance because an active fund has much higher management fees than an index fund. So that's the second own goal.
But what's the difference between what are the costs involved with an active fund and a so-called passive fund? I mean, you've got the same amount of people there, haven't you? Or have you got squads of people going around metaphorically kicking the tires? I don't know why people kick tires, but anyway, you know what I'm talking about. Is it that different, or are they just saying in a marketing way, active, therefore we have got people on the ground and therefore we have to pay more people?
So I think that there's a small amount of truth, is that in general it is more expensive to run an active fund, but the difference between what you pay for an active and a passive fund doesn't reflect the underlying cost, because as you say, in an index fund, really it's quantitative driven, so we have people that run models and they monitor models, but you still need people, but there's no discretion, whereas an active manager, they'll have people that try and analyze companies and they might fly around the world. But you're exactly right. It's a good question, what does it cost? If you look at Warren Buffett, probably the most successful long-term active manager in the history of the last 50 years, there's one person. So he's one person that runs over $300 billion. So even if you are running an active management fund, if you really know what you're doing, it need not be that expensive.
Yeah, I mean, apart from air tickets, and of course air tickets are not redundant, but with conference calling and all sorts of technology, Skyping, etc., do you really need to fly around? And if you are a fund manager and you have both active and passive funds, don't you need the same amount of people, or do you suddenly say to yourself, well, look, we've got a couple of other active mandates that we need to manage, therefore we need to import people from other fund managers? How does it work? Surely you can all do it, within your own little cloister.
I think you can. It comes back to a marketing. What's the perception you're trying to create out there? And I think the active managers are trying to create a perception that it's a very complex. This is very complex. Managing is very complex because there's so many variables you need to understand, and you've got to understand commodity prices and economics and political and social and environmental. And it's really the perception they're creating, because, as we've said, is the way to implement that. You can do it very cost effectively, even if it's active or passive. Certainly, if you look at the results that they achieve, you can't say that you're spending money wisely because you're underperforming the index.
Smoke and mirrors, that's what I say. Earning lower returns before fees was own goal number 1. Own goal number 2, paying higher fees to further reduce their return. What do you mean by that?
So on average, what we found is, in fact, we've been managing money at 10X over 7 years. So into the prior to the financial crisis in 2008, into the crisis and out of the crisis. So you've had a negative market or bear market, and also quite a strong market. But throughout that period, the average large fund manager has produced a return of 1% per year less than our fund. And on average, you're probably paying another 1% in fees, because you pay high base fees.
Just go back to that number again, and that's excluding fees. Just repeat.
Correct, that's before fees. So just what your portfolio earned before anyone took any of their fees off your return, because the return that's published in the surveys is not the return you as an investor earn. You've got to pay your advisors, your consultants, your administrators, your investment managers, your performance fees. So there's quite a few deductions that come off
layers and layers and layers of people within the financial services industry.
That's correct. And what we're saying is that those layers, for most people, they're not adding extra return, but they certainly are taking away extra cost.
Yeah. Okay, and you keep on mentioning yourselves. What I want to say to you is that 10x is not the biggest, so therefore you can be a little bit more nimble. If you had 575 billion, maybe you wouldn't be doing as well as you are at the moment, because you've got X billion under management. How much have you got?
So we have just over 4 billion, and you're right, we're certainly not the biggest, but the advantage of an index fund is that size does not become a constraint because you're not exercising discretion. So if you look in the US, Vanguard, which is the biggest investment company in the US with over $3 trillion, they're primarily an index fund manager. In fact, they got $300 billion of new funds in 2014 alone, which is bigger than most asset managers.
Can you imagine if you were a stockbroker getting a call from Vanguard and saying, could you please buy me some Apple? It would be amazing.
Fantastic. But the beauty for the investor is that you can still earn the market return at a low cost, because even when they're getting those sorts of flows, the liquidity of the markets is such that they can still track the market at a low cost.
Okay, number 3, the third own goal, paying performance fees despite underperforming. So how can you pay a performance fee when you're underperforming? It's like saying, well, if I'm a hedge fund and I increase your wealth by 25%, I'm going to take 20% of that. But you're saying that people are paying performance fees for underperforming.
That's exactly correct. So the idea of performance fees is alignment of interest, is that if we win, you win. But what you're measuring yourself against in an active fund is the average fund manager, not the market. So what we're finding is that the market's, let's say, over there, the average fund manager's over there, and there could be a 2% difference between what the average fund manager is doing versus the market. So you can still underperform the market, but outperform the average fund manager, and charge a performance fee to your unsuspecting client who's none the wiser.
Okay, so it's all to do with beating the neighbour rather than beating the benchmark. I mean, it's when I used to be in the fund management industry, my boss used to say, we're in the upper quartile. I said, yeah, but we were 2% below the all-share. He says, it doesn't matter. We're in the upper quartile, which means we're in the top 25% of the fund managers that are being surveyed. I thought to myself, this is wrong.
You're exactly correct. But the investor is not told the full picture. So all they're told is we outperform. But as you say, what did we outperform? We outperformed the weakest players, but we didn't outperform the market.
Yeah, okay. So what's the message here? I mean, obviously there's a message. You're a bit of a crusader here. You've only got 4 billion, which is tiny in the big scheme of things, big in everybody else's lives, but tiny. So what are you saying?
Well, we're just trying to educate and empower people so that they take a bit of responsibility themselves, and they start to ask these questions, and they become much more informed investors. Because if they are informed investors, they're going to make much better decisions for themselves. They're going to get better value for their long-term savings, and they're going to have better outcomes when they retire or when they need their money for their child's education. So obviously we have a commercial motive at 10x, but primarily we want to educate people so they take more responsibility for their investment decisions.
When you get a flood of income because of interviews like this and because of your performance, and when you get up to 50 billion, 100 billion in years henceforth, will you still have the same attitude, or will you follow the rest of the asset management crowd?
We won't change what we're doing. We only have one set of portfolio, so all of our clients earn the same returns, and we've been doing that since day one. So we're certainly not going to change the way we invest our clients' money, because we think that's right for the long term. In fact, when we started out, a lot of our clients said to us, it's too good to be true. Surely you're going to get us on board in a year or two down, you're going to increase your fees. And what we said is that the reverse will happen, is that this is a scale game. And as an index fund, if you can increase your assets, your costs, your unit cost drops dramatically. And that's what we saw with Vanguard, is that Vanguard, one of the reasons why they're just gaining more and more assets is because they keep bringing their costs down, and the advantage to their clients keeps on increasing. And we'd like to follow that model at 10x.
So it means a slightly sort of spurious comparison, but on the other hand, it's a price war. Potentially, hopefully there's a price war. Look what happened in the United Kingdom. You've got Tesco's and Sainsbury's and Waitrose doing fine, and then along comes Morrison's and Aldi, etc., and they cut their prices, and then the whole pricing system collapsed, and a few people went by the wayside. Is there a chance of that happening in the fund management business in South Africa and the world?
It's definitely happening in the world. We're seeing that by far the majority of new money is going into index funds, and it's coming out of active funds. And as you've mentioned, even those active managers have come under fee pressure. We're seeing that a little bit in South Africa, where the fund managers are starting to cut some of their fees, although it's only at the margin. But that would be a fantastic outcome for investors, because it's all about, are the investors getting value for their money and are they paying a fair price? And at the moment, we would say is they're not getting value for their money because they're underperforming, and they're paying outrageous fees. They're just not aware of it.
Yeah. Okay, well, you said the right thing there, paying outrageous fees and they're not aware of it. Education is the key here. Well, we've got you here in the last minute or so. What about the markets? What do you think?
Well, they keep on surprising us on the up. I think we had a discussion maybe a month or two ago. I mean, last year the all-share index ended just under 50,000 and now it's hovering at about 52,000. So what we've seen is a period of 6 years now where you've had above average long-term returns. And at some stage, the market is going to give some of it back. We don't know when, we don't know why, or what's going to be the catalyst for that. But I think the important point for an investor is not to worry about the short term, because no one really knows if and when the market is going to
That's what a lot of deep value investors have said for the last 2 to 3 years that have been in commodities. Don't worry about the short term, because in the long term these things will revert to the mean. But people's patience are wearing thin, and I'm sort of worrying about this bull market that's been going on now for 6 weeks and 6 years and 1 week. I just wonder if this is different this time.
Well, I'm not a believer in deep value at all, because I have no idea what deep value means. I mean, when the market goes up 13% last year and some fund managers go down 2%, to me that's not deep value. That is reckless investing.
It's deep destruction.
It's unconstrained. There's no risk management whatsoever. So certainly I don't buy deep value and what some fund managers are trying to justify where they've underperformed. Over a 3-year period, you've had some managers that have destroyed 50% of your savings.
Do you believe then, sorry to interrupt because this has suddenly hit me, when I was a day trader, because I worked on a trading desk and I had a little account that I traded for the company, they would say, put in a strict stop loss. This is your stop loss, and if it gets there, then that's it, you're out. It seems to me that the long-term traders say, well, this is a long-term position, despite the fact that we're down 30-40%. Why don't they employ the stop loss philosophy?
Correct. I'll tell you what it is. When you're trading for the bank, it's their money that's on the line, and they say with our money we have a loss limit. When it's other people's money, there's no losses because it's not your money. So you're speculating. If it does well, you'll take the upside and the performance fees. If it does badly, well, you blame it on the markets and it's their loss. But I think it's a travesty of justice that you have these people where in our high equity fund, for example, that's been returning roughly 16-17% per year, you've got some high equity funds that are returning 8% per year less over 5 years. And there's no risk management whatsoever.
That can of worms has just been opened and those worms are calling out. Stephen Nathan, thank you very much for coming in this evening. That's Stephen Nathan, who's the CEO of 10X Investments.